The housing market is slowing and layoffs have been announced. However, is there opportunity in this market? That's what I'm going to dive into in this video. So smash that like button and subscribe if you're new. You're watching More Money. Let's get it. What's up, guys, and welcome back to the channel, where the goal here is to help at least 1,000 people achieve financial independence much sooner. And let's dive right into this because the housing market is going nuts now. You can see here that of the companies that I'm following, over the past week, the major decliners, all 5 of the top 5 major decliners were housing companies. And so you can see Dreamfinders, LGI Homes, and Tri Point Homes are builders. Zillow, of course, is the search website, and Open Door is a buyer and seller of homes. And so you can see that they're all down. Dreamfinders is down almost 27%. And so what's causing this to happen? And part of the reason is that the slowdown in the housing market is now causing layoffs. So you can see here that Redfin came out and said that they're going to be slashing 6% of their employees due to market conditions, and that's expected to be completed by the end of the month. Once you start seeing layoffs happen, you're now starting to see real pain in this industry. And so moving on, you can see why this is happening. Well, the 30-year fixed rate mortgage has more than doubled since the first quarter of 2021. We were under 3%, maybe around that 2.7, 2.8%. And now we're hovering and getting close to that 6% range. So of course, it's going to push down affordability for homes. And then moving on, you can see, however, that although we're at that 6% range, overall rates are still at historically low levels. And so this is what the boomers are going to say to you when you complain about home interest rates. They're going to say something like, when I was buying homes were around 15% interest rates. Yeah, but here's the problem. You can see here that the last time mortgages were above 5% was in the 2008-2009 market. And back then, the average price of a home was around $200,000 to $250,000 per home. Today, prices are 70% to 100% higher. Therefore, they are less affordable. And so if you have higher interest rates and higher home prices, something has to give, because affordability is out of whack. When the boomers were buying homes, when they were paying interest rates of 15% or more, the home values or the prices of the homes were substantially lower. Thus, they were affordable. People don't buy home prices, they buy mortgage payments. And so right now, the mortgage payments are exceptionally high. And so something has to give. And what that something is, in my opinion, is going to be home prices. They're going to decline. And you can see here that the existing home sales are already cratering. They have now declined to levels that we haven't seen in over a year. And just taking a step back, you can see that home sales are still pretty elevated on a historical context, but I believe that they are likely to continue to decline further as affordability is high. And so the question you guys might be asking is, why is it that home prices remain elevated in an environment where interest rates have shot up and even doubled? Well, you can see here that the reason why home prices are remaining elevated, because we have historically low amounts of inventory being put for sale. And so housing inventory remains at historically low levels. This is my thesis for home builders and Zillow, albeit we'll likely experience near-term and potentially even medium-term pain as owners of these businesses. And so what do I mean by my thesis? I'm really essentially saying that the amount of inventory that's available is at historically low levels, and the amount of new homes that the market needs is at low levels. And so as the prices of homes come down, the builders are just going to build. So if they're buying land for cheaper, they're just going to buy land for cheaper. And so there are going to be buyers that want to purchase homes that are going to come into the market. However, I do believe that there's going to be medium-term pain here, especially if we have a consumer-led recession, which a lot of people are predicting that could happen as the rates continue to get increased and we potentially run into layoff type situations happening across the board. Haven't seen that yet in the job markets, but of course, it's very likely that that's going to happen if rates continue to increase and companies start scrapping growth plans or reinvestment plans into their business. And you can see here that the Federal Reserve did recently raise interest rates by 75 basis points, However, it's still historically low, but as everyone is expecting, the rate is going to continue to increase, and that could finally start the home price decline that everyone is expecting. And so I did mention LGI Homes earlier. That was the name of the security that dropped the most this past week. Well, you can see here that management is currently guiding for a 7% increase to revenues. This is from the models that the Patreons get access to. And so they're guiding to around $3.3 billion in sales. Now, my question is, if they can grow revenues at just 2% over the next 5 years, this is a really compelling opportunity. However, we know that revenue is actually going to turn around. I don't think revenue is going to continue to grow even at 2% year over year. However, there is an argument that revenue could continue to grow if home prices come down, because more and more people will be able to come back into the market, but that's if they have jobs. So there's a lot of variables going on here, but I would think that it's more likely than not that LGI's revenues decline, and that's kind of what the market is seeing right now as well. However, in my model, I'm just throwing a 2% flat growth across the board. And so one of the reasons why I do believe that revenue is going to decline over the next coming years, at least in the medium term, is notice how their cancellation rate is ticking upwards, suggesting that pain could be on the horizon. The other thing is, look at their backlog value. I always like to look at the backlog value as an indication of what the future looks like. The backlog value has been cut in half since last year. So that does suggest that there is pain on the horizon. And you can see that at present, I am valuing the company at approximately $162 per share. I fully admit that that's an overvaluation because I haven't built in pain or revenue declines in the subsequent months. I really don't know how to think about it yet. And once I sort of have a little bit more information, I will start building that in. But what I do want to point out is notice that the current share price, based on the management's forecast for earnings, is trading at 4.6 times earnings. So effectively what's happening here is that investors are already expecting around a 50% decline in earnings to justify this earnings multiple, which I would think could potentially happen. And so you don't actually have a price to intrinsic value of 50%. It could be fairly valued if you just look at the medium-term pain right now. The way I'm thinking about this is more longer term. I'm thinking that the intrinsic value is somewhere in between there. It may not be at the $162 level, but it's obviously not at the $80 level either. It might be at the $120, $130 level. Who knows? But here's one interesting point that I do want to point out for you. If you're looking to get into some builder exposure, the cash secured puts provide a really interesting opportunity, because using a cash secured put can allow you to generate a greater than 15% return. And if you are exercised and you have to deploy that capital, you can end up buying LGI Homes at 3.4 times next year's earnings. So that's a huge margin of safety for even if earnings decline, because then they would have to decline 66% for you to own the name at a PE value of 10 times, which is effectively where they've traded historically. And so I really want to know what you guys think about this. The best way is to download the model and change the inputs to see what the value comes up for you. And one of the ways to get access to that model is a lower Patreon level tier. And like I always say, if you do decide to join the Patreon and it's not for you, let me know within the first month and I'll fully refund that first month's payment for you. So there's absolutely no risk for you. And there's a huge amount of companies in the Patreons for you to take a look at. Now, with that said, one important thing that you guys got to be paying attention to, especially if you have exposure with Chinese listed names, is that there seems to be a bipartisan growing support for disallowing investments into China by the US. And so you can get to that video right here.